Hey, Robert.
Hi, Yaron.
So the world just won't slow down, and there seems to be constant kind of market upheaval, movements, a lot of volatility. We just experienced two massive up days in the stock market, a little bit of a down day today. But all of this coming off of some big movements in the UK. The UK government proposed a budget that saw government spending go up and taxes being cut, marginal tax rate, particularly the top marginal tax rate actually being eliminated. That was the proposal, and markets went nuts.
Well, markets are just going nuts all over the place.
Yeah.
The more fun is what's happening with Twitter and the back and forth. And I'm buying it, I'm not buying it, but
sure, we can talk about Twitter too.
It was really amazing how strongly UK markets reacted, and it resurrected the term bond vigilante, which was a very popular term in the 90s, where it continually stymied attempts to create new government programs or to expand government. And it would be interesting to see if bond vigilantes came back. They clearly are not back in a general sense, because the US Treasury yield is still way below inflation, below core inflation, below every measure of inflation.
Yeah.
So that's not what you get with bond vigilantes, and at least in response to things like the Inflation Reduction Act, which
so say a little bit about what bond vigilantes did in the 90s, particularly during the Clinton administration. It was, every time the government proposed big spending or anything like that, interest rates would spike up, right?
It's interest rates are, people tend to today particularly attribute them to the Federal Reserve or whatever central bank is behind the currency. But that's not really the case. It's true for very specific interest rates, the Fed funds and any interest on reserves, but the longer term interest rates are set in the market, and then central banks can impact them. And we saw that in Britain recently, but it's a central bank swimming against the rest of the planet. So it's really a challenge, and it creates all sorts of other problems if central banks have to try and fight the rest of the market. We saw that in Great Britain when Soros broke the pound. That eventually, if the economics are on the side of the rest of the world eventually wins. But in the 90s, we were coming off of these extraordinarily high interest rates in the late 70s, in particular the early 80s during the Volcker years. And interest rates came down a lot, but they came down from such high levels that we were still talking about interest rates that were in the high single digits. And so if you think about the government's budget, and the government is carrying debt, then if you're paying 7, 8, 9% on that debt, that's a serious line item. And the difference between 7 and 9 is a big deal. It's as big as the difference between 1 and 3. And so we saw every time that it looked like the commitment to keeping government a reasonable size, keeping government spending a reasonable level, keeping taxation at a pro-growth level so that inflation would continue to go away. You can continue to see disinflation. Anytime there's a movement against that, interest rates would spike up on the presumption that, okay, we're going back to the 70s and I want to get ahead of the curve. I don't want to be holding 7% bonds when rates go to 14. And so suddenly rates go to 9%. And it was a very clear market signal in terms of what investors thought would be the impact of various government programs. It was basically a prediction market before anyone was using those terms. And the government took it very seriously. Giving props, the Clinton administration didn't, they complained about it, but everybody complains about discipline, whether it's financial markets or your mother. Everyone's unhappy when they can't do what they want, but listening to the feedback is an important part of managing a effective and responsible government. And the Clinton administration did do that. We eventually saw budget deficits go to zero and a brief surplus. And I think that was what really changed the overall, that's what put the bond vigilantes into hibernation, it was no longer necessary to react so strongly to proposals in government because you had a decade of credibility that no, we're not going to go back to the 70s.
And then, of course, the government did start playing around with long-term bonds during the financial crisis, and it's hard to tell exactly how big of an impact central banks have had on the term structure over the last 10 years, given how much they've dabbled.
Well, certainly there was some, usually people call it qualitative easing. And that, of course, was minuscule compared to what the Fed did during COVID.
Yep. And
so, yes, we had a good, a solid 18 to 24 months where central banks were the marginal buyer of most government debt. Now, the Fed tended to stay shorter term and not buy a bunch of 30-year, but the Fed was the marginal buyer of U.S. Treasury debt. The Bank of England was the marginal buyer of the British government's debt.
Yep.
And so rates were being set by a marginal buyer whose intentions, whose incentives, whose goals were not your typical, okay, I want to make sure that I'm not buying debt that is paying half of what the interest rate will be in a year or two. And so the Fed ended up buying a bunch of treasury debt and mortgage-backed securities, agency debt that was at rock bottom rates, and that was intentional. But they weren't trying to make money. And in fact, the Fed probably has $1 trillion in mark-to-market losses on its balance sheet because it bought all those mortgages that were going out at 3%. A lot of them ended up with the Fed, and now mortgage rates are 6.5%, and they're still holding 3% mortgages.
Yep.
The Fed does have an advantage of it. Their cost of funds is a little bit more in their control than most people's or most entities. But it was definitely there was definitely impact across the term structure.
So the UK government issues this new budget. It's called a mini budget. I'm not sure exactly why, but it came out and markets freaked out in anticipation of, I guess, massive deficits and maybe increased pressure on inflation. And the Bank of England, so interest rates went up, like some of the biggest moves I've ever seen in the bond markets. I mean, they really shot up. Interest rates shot up, and the Bank of England stepped in to intervene. The pound went down almost to $1. I mean, I was actually eager to see it stay there because I'm traveling to UK next week. So I was thinking, yes,
everything was going to
buy
be on sale.
all these goodies for nothing. But the Bank of England stepped in, committed to buying bonds, which, of course, as they buy them, that would lower yields, and everything kind of bounced back. And seems to be bouncing. It seemed to be bounced back once the Bank of England committed to normalizing kind of the bond market.
Well, I think that first of all, for reference, when I was young and barely understood finance, the reference point for the pound was 2 to $1.
I remember.
I remember. More recently, and not that long ago, it was $1.50. A nice round number that was roughly where the pound would be.
Yep.
And now all of a sudden it's $1. So that's a huge change. And we're not talking about a third world country where huge changes are kind of the norm. We're talking about Great Britain. The previous superpower of the entire planet. So these are really big changes. Now, the way that interest rates impact a bond depends very much on its how long it's going to be out there, its maturity, or more specifically, its duration. And the British government issues perpetuities, which the US government doesn't do. So people may not be aware that you can buy a bond from the British government that is a promise to pay forever.
Yep.
You're not going to get paid back. You're never going to get your principal back. You're just going to get interest forever. And that's called a perpetuity in Britain, the gilt. And it's a great instrument for people who have very long maturity liabilities. So if you buy a gilt, it has got an infinite maturity. It's got an extremely long, in theory it's infinite, but it's got a very long duration. And so it stretches out the duration of your asset portfolio. So stocks also have very long durations. They don't get paid off. But if you have any other sort of instrument that has a fixed or finite maturity, then gilts are a great way to stretch out your liabilities. So basically, insurance companies that expect to hold premiums for decades and ongoingly for centuries, because people pay when they're young and they get benefits when they die, they use these gilts a lot. And it turns out the way that you do it, if you want to stretch out your maturity, is you borrow money short and you buy long. So you would borrow money in basically the commercial paper market, and then you would invest it long. And that gives you a really mismatched duration, but it offsets the mismatched duration that you have on your liability side. And of course, then if what happens in the real markets, in theory, it doesn't make any difference because your overall balance sheet is actually in better balance than it was before you did this. But in practice, when gilt rates shoot up, the price shoots down. And because you borrowed to buy them, the people you owe money to start to get nervous about the collateral, and they start asking for more collateral. And so when you have really sharp, really quick moves, it creates liquidity crises within this particular set of investors, which is a large set of investors and an important set of investors. So the Bank of England steps in. I don't know that that's a good thing. It does seem like it's a reasonable activity. It wasn't speculating being done by these insurance companies. It was actually trying to manage their overall risk. But one of the risks is liquidity risk, and bailing people out just makes them ignore that risk in the long run. But the Bank of England did come in with the assertion that they weren't going to do this, that they weren't trying to bring rates down. They were just trying to bring order back to the market, which means, if the market rate's going to go from 3% to 6%, we're going to let it, but we're not going to let it happen in a week. It's going to happen over the course of months or maybe even a couple of years. And once that credible commitment was made, then suddenly the marginal buyer's like, oh, wait a minute, I don't need to get 6% now because it won't be 6% tomorrow. The Bank of England said it won't be 6% till next year, and this can move in what people call an orderly process. Now, a sharp jump is maybe an orderly process, but if it's being driven by margin calls, then maybe it's not. So it's complicated, but it's just a good reminder that when you start messing around with financial markets, and you suppress interest rates, and now they have to go back to their natural level, it's going to create all sorts of problems on the way back.
So the Bank of England has not changed its commitment to continue raising interest rates, to continue fighting inflation. This was not them completely backtracking. This was them trying to solve a liquidity problem.
That's their communication.
Short run, or at least that's what they're saying.
That's their communication. Yeah.
And then the markets for now seem to believe them, and we'll see how this heads out. And of course, this had some spillover effects into the U.S., but nothing dramatic, really.
I thought it was pretty dramatic because long-term treasuries were running in the low to mid threes, and then suddenly they were 4. Yeah. And there wasn't any similar, market microstructure explanation for what was going on. It looked like contagion to me. Now, 3.5 to 4 is not a huge move up, and in fact, I've been wondering why this hasn't been happening.
Why isn't it at 4 already? Exactly.
Yeah, given the Fed funds at 3, and it's going to be at 3.75 most likely in a month. It seems crazy that the long bond isn't at 4 or even 5, but the timing is suspicious. I don't think it's coincidental that it happened around the Bank of England swings. And I would say that I don't think investors are fully convinced by the Bank of England's. At the margin, they are, obviously, because rates came down significantly, although not back to where they were. But if you look at inflation in Great Britain and you look at the challenges that Europe is facing, it's going to be very painful to bring inflation under control. It's probably going to be painful in the US. It might not be, but in Europe, it's almost certainly going to be.
And a lot of that is driven by energy costs going into the winter and a huge subsidies. I mean, I was reading yesterday that the German government is committing 200 billion euro to subsidize business during this crisis. And all the other Euro countries are saying, wait a minute, this is a violation of our agreements about not to subsidize business. We can't afford to subsidize our businesses, so it's not fair that you Germans are subsidizing your business like this. So it's creating real tensions within the European Union. And this is all because of this energy, but broader, it's because of inflation.
And because it's coming right after COVID. So what happened with COVID is government said, we're going to shut everything down.
Yep.
And then we're going to compensate everybody. And that was very expensive. And it created eventually the inflation that we're experiencing now. But you can, especially at the time, it didn't seem like a terrible idea. I mean, no one knew what was going to happen if you shut down the economy. Now, maybe we could talk about not shutting down the economy or giving more flexibility to how things would evolve. But given how things went, it wasn't a terrible idea, but it did set us up for both having set a precedent when there's a shock to the system, because COVID was clearly a shock. And basically, Putin invading the Ukraine is a shock to the system that is very near and dear to Europe. And arguably, this is the way to go, is to say, look, we're going to have a year where we, I haven't seen any clear acknowledgement. We screwed up by putting ourselves at the mercy of a maniac, but that's what happened, and it went badly. And given that we screwed up, we're going to, now, the government doesn't actually produce any wealth, so they can't make it right, but they can say we're going to steal from the future to make today okay. And it's potentially a reasonable thing to do given a shock to the system. But every time you have a shock, you reduce your ability, you increase the expectation that you're going to keep doing that and reduce your ability to be able to do that without really harming the future. So each time,
and some countries can afford to harm the future in that way, and some countries can't. I mean, Germany can probably raise huge amounts of debt because it's got a relatively solid economy. It's got a real production base. People believe the Germans will pay back their debt. Not so much Italians, not even probably the French, certainly not the Spanish. So they're unhappy because now it's going to affect competition.
Yeah, it's funny. Nobody even talks about Greece anymore because they're much bigger fish in the fire.
Yes.
I'm shocked that there hasn't been more. Well, Germany needs to subsidize everybody else too, because that's what I would expect to happen. Is them not to say, okay, we're not going to subsidize anything. It's to say, well, what about us?
No, that is the pressure. The pressure is to do it through the European Union, which basically means Germany subsidizing everybody. Yeah. So because if the European Union decides to subsidize everybody, where's that money coming from? Ultimately, it's coming from the Germans, and it's their credit rating that kind of backs it all up. So Europe is a mess. Inflation is bad. They're heading towards a brutal winter, probably energy-wise. It's going to be cold. It's going to be hard to, I think production is going to, or the economy is going to suffer. UK is a mess. We'll see what this government does. I mean, I didn't think, and I was reading an article by Tyler Cowen, who didn't seem to think that their proposal was really that bad. In many respects, maybe had some good elements to it going into recession, particularly eliminating the top marginal income tax rate. By the way, they've backtracked from that, so they've reinstated it. But the markets reacted like that anyway. So we'll see what this government does, but it doesn't look good. Where do we stand in the US? So we're expecting inflation numbers next week.
Next Thursday.
Next Thursday. And the Fed will decide, I guess, a week after that, if it's raising interest rates again, or 2 weeks after that, whether it's raising interest rates again, probably will. It's just a question of how much. And stock market went on a crazy Monday, Tuesday, where everything would look good. The future looked rosy.
Yes, prices just went up. Bonds, stocks, gold, Bitcoin, you name
everything. Oil, everything was correlated. Just amazing. And all the news was negative. So the stock market went up on news that employment was weakening and production was weakening. So how do we make any kind of sense of all this?
I can never make sense out of the production weakening. I mean, in a different world where inflation is low, then the Fed pays a lot of attention to the other aspects of the economy, the other dimensions. And if production is weakening, then the Fed would cut interest rates. Now, it would be better for everyone if production was just roaring and the Fed didn't cut interest rates. So I never quite get it, but in particular, I don't get it now, because the Fed has been very clear, and all of their credibility turns on them being laser focused on inflation. And until inflation and interest rates have met somewhere, hopefully in the middle, and real interest rates have gone positive, the Fed can't look at, oh, well, production's weakening, now maybe we should stop raising rates or start cutting rates. No, inflation is all that matters. Yep. Now, in employment, I don't get the US employment market. I mean, clearly something happened in COVID, and yep. there are lots of explanations, but nobody knows what really the underlying factor is. That the number of people who are interested in working just went down dramatically, and it hasn't bounced back. And so we've had a multiple of the number of job seekers. We'd have a multiple of number of jobs, which is, it seems like it's actually a great situation. If there are 2 jobs for everyone who wants a job, except then even if everyone grabs a job, you're still left with half of the jobs that you were looking to fill being empty. So it's much better for the economy if that is somehow in balance, and ideally the number of job seekers would go up and the economy wouldn't slow and the number of positions wouldn't go down. But that doesn't seem to be happening. And so the fact that the number of positions is starting to go down, it has to happen. It's good for the economy if you take the number of job seekers as fixed, but it's not a 5 or 6 or 7% bounce in 2 days kind of good. It's just, it's what needs to happen and will happen, because the Fed will make it happen, because they're not going to be focused on anything but inflation, and bringing inflation down, if you're not raising production dramatically, is going to require bringing demand down. And that seems to be the path we're on. It sucks, but that is.
Yeah, and there's no signs so far that inflation is being mitigated. In given that interest rates are still negative, real interest rates are still negative. There's no reason to believe that inflation is going to go away anytime soon, until the Fed gets even more aggressive.
Well, I think the fourth quarter may end up looking better. Inflation in the third quarter was not terrible. It wasn't great, but it wasn't terrible. Inflation in the fourth quarter, if it's not terrible, the overall inflation numbers, the year comparisons are going to start looking a lot better.
Yep.
But we have a long way to go before meeting in the middle. So yeah, the Fed will continue to raise. I think their next meeting is early November. It seems almost certain that they'll go 75 basis points, if only because of the last 2 days. In the same way that the Bank of England saying that they were going to guarantee an orderly market in gilts, it just happened. In the same way, right now, the Fed wants to be able to just say, we're going to control inflation and have everyone believe them, and not get exuberant about one little number. The Fed is not looking for the stock market to go up 30% right now. That's not deflationary. And so until there's, and I hate the word capitulation because it's used in the market in a weird way, but until there is capitulation of optimism about the Fed doing anything but getting rid of inflation, and inflation could come down dramatically on its own. I just haven't seen any evidence of that, not in my daily life, not in any of the aggregate numbers. Now we have hurricane damage, so the price of lumber is going back up. The price of gas in California is over $8 in some places. It's the optimism. I see no reason to be optimistic. But what really will determine it is in the future, and I'm not very good at predicting the future.
Yes, and timing and when it all happens, but yes, there's no reason to believe we're going to see a significant reduction in inflation. There's no reason to believe the Fed won't overreact, won't ultimately increase too much. And I don't even know what too much means. It's not clear that you can actually eliminate inflation without causing recession. That's where we are. And certainly in 1982, that was the reality. And it was a deep recession. It was quick. It was over relatively quickly, but that's primarily because of deregulation and tax cuts. But it was deep. And there's no reason to expect any kind of different outcome this time.
Well, I guess you're not as you're not as reluctant to predict the future, but
no, I never am. You know me.
Yeah, you know, and the 82 recession came after. It was some people thought they really should just say there was 1-2 year recession. It was a double dip. It came after a much longer recession.
Yep.
Our last recession was the COVID recession, which wasn't even really a recession. It just was a self-inflicted recession. And if we try and imagine what's going to happen, there are scenarios, I think, where we do get a soft landing. But when you have a Fed that's committed to not to disinflation, to not having inflation over even 3%, then they are almost certainly going to overshoot, because they're 100% committed to not undershooting. And you know, it's can you get the bullseye when you're aiming to make sure you don't hit any other part of the target? Like that's what it is. You have to say, okay, you can hit the bullseye, but I can't hit the rest of the target. What am I going to do? Well, nobody throws the dart. Then you just deal with it.
Yeah, I'm even more cynical than that a little bit, because this is a Fed that didn't see inflation coming. There's no reason to expect them to get it, you know, because the measures, the information, the very nature of central planning around these things is such that you're just not going to get it right. It's not clear that there is a right, but you know, ex post there always is, but it's not clear that you can actually accumulate the data to get it right. So it's something bad is likely to happen, and that something bad could be they undershoot and therefore inflation bounces back, which is possible, or they overshoot and we get a deep recession. And even then, inflation could bounce back. We saw that during the 70s, where we had recessions and then inflation bouncing back. So the inflation creates, it really creates these challenges that are very hard to overcome. And you know, our last experience with this globally was the 1970s, and it took a long time and it took a lot of pain to get out of it ultimately.
And that was the real mistake with team transitory. It wasn't that inflation might not be transitory. It's that the payoffs were asymmetric in the exact opposite direction, that the letting inflation spike up was going to be a bigger cost than letting the economy slow down, because it is, you don't get in any trouble when you ratchet things back and try and become accommodative and try and stimulate. Like that's easy. Nobody complained. There's no downside to that. No, you know, people will say, okay, now you have to worry about inflation, but no one will give them credibility, because people have been saying that since the mid 80s, and it's always been disinflation. But getting on the other side of it, where we are, it's a much harder place to be.
So, okay, so you get the final word on, is Musk buying Twitter? And if he is it a good thing?
Well, you know, Carl Icahn bought $500 million worth of Twitter on the gamble that the deal would close.
Interesting.
Because you can, make 20% in a month. Now, of course, you're going to probably lose more than 20% if the deal doesn't go through. But it seemed from a legal perspective, it was clear that the deal was going to close. Now, it's an unprecedented situation, so things could still go wacky. I mean, so Elon Musk had, agreed to buy Twitter. He actually convinced them to sell to him, made a very attractive offer. And then the stock market, particularly technology stocks, went into the toilet, and suddenly his offer looked really expensive. Selling his other stocks looked a lot less attractive. And he said, you know what, I don't want to buy Twitter.
He changed his mind.
He changed his mind, and unfortunately, he had signed a definitive purchase agreement, and he didn't have any path out of it. But that doesn't mean that you can't find it. Doesn't mean you can't renegotiate the deal. All of those are possibilities. And what it looks like is the deal go through as originally agreed. Now we'll see, because he said he wanted to buy the company, and then he said he didn't want to buy the company. Now he says he want to buy the company, and he could say, I don't want to buy the company. The big hitch is going to be selling the debt that is behind the deal. There's, I don't know, 12 or $15 billion of debt as part of the purchase agreement. That debt has commitments from investment banks. These kind of debt deals looked pretty attractive back in the early part of the year, and now they're much less attractive. Interest rates are way up, credit spreads are up. And then of course Twitter is a unique property, and now it's going to be run by someone who's been wildly successful in other businesses, but has been basically talking shit about Twitter for months. So it is possible that either the debt doesn't get sold, although I think the banks are probably on the hook to buy it themselves. Like I think they made a firm commitment to place the debt, which is going to be horrible because they're going to lose billions of dollars. It's probably a 20 to 25% discount to place the debt. But as long as that happens, then I think the deal will most likely close. There's a contingency if he can't get the debt financing, and somehow if the banks can get out of it, then I think Musk walks away. I think he has legal standing to walk away. But the deal probably closes, and it's going to be fun to talk about because Twitter is a unique beast, and it's not evolved at all in the way that I hoped it would. We had a client who was an investor in the first Union Square Ventures Fund, which was the first investor in Twitter. So we heard about Twitter very early, and we were just confused as everyone. Like, how is this what you want? And so because of the nature of tweets, it's turned into a lot more of a popularity contest than an intellectual popularity contest, which is kind of what I was hoping for. Although now you can do long series of tweets. And so there's a mix of this, but mostly people are following, the Kardashians on Twitter. And
Trump is going to be back with with Musk there. So that'll definitely increase viewership. It'll make it more interesting.
And Elon
but
Musk
they still have to figure out how to monetize it. So that's still a challenge for them.
Or not if it's a private company, although they have to service the debt. So maybe. But Elon Musk is popular on Twitter not because he gives thoughtful, insightful, informative tweets. It's because he's entertaining. So Twitter has become entertainment, and Substack is becoming what some of us hope Twitter might be. But entertainment is
very valuable.
It's very valuable, and it's very impactful. And it's not mutually exclusive with intellectual content. So I think where Twitter goes next is going to be really, really interesting. And it wouldn't shock me, given Musk's success, if something came out of it that none of us really saw coming. Nobody really believed electric cars were going to do anything. Nobody believed that private space travel, like what this guy's nuts. Well, I hope he's nuts a third time here, and that something comes out of this that's really wild. So. And you pointed at a tweet that he had about the X app, which I think would be fascinating if Twitter evolved in a way that, we've been talking about with crypto, that where you have something that empowers everybody outside of existing structures. Because, PayPal was cool. And PayPal is cool. PayPal is a very valuable company, but it's basically a tweak. It's another layer on the payments industry. It's not that different from a credit card. But something coming out of Twitter, it could be a total game changer, something that we might not even imagine. And given the approach that Tesla and SpaceX have taken, that it's going to be a very iterative process where it's allowed to evolve, which has been the biggest problem with Twitter. Is it hasn't really evolved. How people use it has evolved. It doubled the number of, oh my God, but small incremental improvements that add up to transformation, that just hasn't happened.
We will be talking, we'll be talking a lot more about Twitter. I have a feeling, given if the deal goes through, I'm looking forward to it. I think it'll be fun to watch, if nothing else. Thanks, Robert.
Thanks, Yaron. Talk soon.
Yep. Bye.